There's this guy on Reddit who posted his portfolio last month. $43,000. Generates about $4.70 a day in dividends. He checks his phone every morning, screenshots the notification, posts it to his Dividend subreddit. 172 days in a row. Someone asked him why. He said, "It's the only thing that makes me feel like I'm doing something with my money." Here's what nobody told him. His brain is running the exact same reward loop as someone playing a mobile game. Except instead of collecting digital coins, he's collecting actual pennies. And somehow, this might be the smartest investing psychology hack of the last decade. Or the dumbest. I honestly can't tell anymore. So here's what I'm going to explain. How almost daily dividend portfolios actually work, why your brain is hardwired to love them even when the math says you shouldn't, and whether this whole thing is just elaborate financial theater or if there's something real here. Because I spent 10 years running a business where I had to understand cash flow psychology. And I'm going to tell you, the people buying into these portfolios aren't wrong. They're just not right for the reasons they think. Let me start with a story about vending machines. Not a metaphor, actual vending machines. Back in 2007, there was this behavioral economist named Dan Ariely who ran an experiment. He gave people two options. Option A, insert $1, get one candy bar, 20% chance the machine also spits out a second candy bar for free. Option B, insert $1, get one candy bar that's 20% bigger. Mathematically identical value. Guess which one people chose? Option A, every single time. Not because it was better, because the uncertainty and the potential for a surprise triggered a dopamine response that the guaranteed bigger candy bar couldn't match. Now, here's where it gets interesting. Those daily dividend notifications on your phone, they're running the same psychological script. Every time you see dividend received $3.12, your brain gets a tiny hit. Not because $3 changes your life, but because it feels like winning. And here's the dirty secret about human psychology and money. Feeling like you're winning is often more powerful than actually winning. I've got about $370,000 invested right now across different strategies. About $60,000 of that is in monthly and weekly dividend payers. Not because the yield is better than an S&P 500 index fund. It's not. The S&P averaged around 15% annually over the last 5 years. Most dividend portfolios I track are doing somewhere between 8 and 11. So why would anyone choose the lower return? Because the S&P doesn't send you notifications. It just sits there, silently compounding, giving you absolutely zero feedback that anything is happening. And the human brain interprets silence as inaction. Think about this. You invest $10,000 in January. By December, it's worth $11,500. 17% gain. Fantastic year, but you never felt it. No notifications, no deposits, nothing. Your brain categorizes this as I put money in a box and ignored it. Now, same $10,000 in a dividend portfolio. It returns 9%, so you end up at $10,900. You lost by $600 in pure returns. But your phone buzzed 87 times over the year. Each time, your brain logged, the money is working. Which investment felt more real? This is where everyone tells you that feelings don't matter, math matters. And look, I'm a data guy. I read SEC filings for fun. I have a folder of spreadsheets analyzing expense ratios down to the basis point. But here's what changed my mind about dividend investing. I watched my own behavior. 3 years ago, I had about 40% of my portfolio in pure growth stocks. Tech companies, no dividends, just price appreciation. I checked that portfolio maybe once a month. Then I moved 15% into monthly dividend payers. Suddenly, I was checking weekly. Not because the dividend portfolio was doing better, but because it was giving me information, and information drives engagement, and engagement drives better decisions. Let me tell you about my buddy Marcus. 51 years old, works in logistics, makes about $120,000 a year. He's got $280,000 in his 401k, all in target date funds. Totally fine strategy. He also has about 90,000 in a taxable account that he built over 15 years. Up until 2023, that 90,000 was in 4 stocks: Apple, Microsoft, Amazon, Google. He never touched it, never added money, never rebalanced. When I asked him why, he said, "I forget it exists." Then his coworker told him about monthly dividend ETFs. He moved 30,000 of that 90 into a dividend portfolio, yielding about 4.2% annually. Suddenly, Marcus is contributing $300 a month to his taxable account. Every month, like clockwork, because now he sees it working. Do the math on that. He went from contributing $0 a year to contributing $3,600 a year. After 3 years, that's an additional $10,800 in capital, plus whatever returns. The dividend portfolio actually yielded less than his growth stocks would have. But the psychological trigger of seeing monthly deposits turned him from a passive investor into an active saver. His lower yield investment made him more money overall because it changed his behavior. This is the part that finance Twitter hates. They'll tell you dividends are tax inefficient. They're right. They'll tell you dividend-focused companies often have lower growth. Also right. They'll tell you that dividends are just giving yourself your own money back, since the stock price drops by the dividend amount on the ex-dividend date. Technically correct. But they're missing the entire psychological layer. Because humans aren't rational. We're rationalizing. We make decisions emotionally and then construct logical frameworks to defend them afterward. Now you might be thinking, okay, but if I know it's just psychological manipulation, doesn't that make it stop working? Nope. This is the weird thing about behavioral economics. Even when you understand the trick, it still works. I know exactly why I get a little dopamine hit when I see a dividend notification. Doesn't matter. Still get the hit, still makes me more likely to invest more money. The trick isn't in fooling yourself. It's in using your own psychology as a tool instead of fighting against it. Here's the structure that actually works if you're going to do this. You need 3 buckets. Bucket 1, your boring core. This is 70 to 80% of your investable assets. S&P 500 index fund, total market fund, target date fund, whatever. This is your getting rich slowly money. You ignore it, check it once a quarter, let it compound. Bucket 2, your income layer. This is 15 to 25%. Monthly dividend ETFs, REITs, preferred shares, baby bonds, whatever generates regular cash flow. This is your feeling productive money. This is what you check, what gives you notifications, what keeps you engaged. Bucket 3, your gambling money, 5 to 10%. Individual stocks, crypto, options, whatever scratches your "I'm going to outsmart the market" itch, you're going to lose most of this. That's fine. It's the pressure valve that keeps you from doing something stupid with buckets 1 and 2. The biggest mistake I see is people who try to make their entire portfolio into bucket 2. They see the daily dividend notifications, they feel productive, and they go all in. 100% dividend stocks. Then they're genuinely leaving money on the table because dividend-focused portfolios do have lower long-term growth. The math catches up eventually. But the opposite mistake is just as bad. People who put everything in bucket 1 get bored, see some meme stock or crypto pump, and blow up their entire strategy chasing excitement. Let me walk you through a real scenario with actual numbers. Let's say you're 42 years old. You've got 150,000 in investable assets outside your retirement accounts. You want to build toward financial independence, but you're not trying to retire for another 15 years. Here's what a psychologically optimized structure might look like. Bucket 1 gets 110,000. You put this in something like VTI, the Vanguard Total Market ETF. Expense ratio of 0.03%, just absurdly cheap. Over 15 years, assuming a conservative 9% annual return, this grows to about 400,000. You never touch it. You barely look at it. Bucket 2 gets 35,000. You split this across 3 monthly dividend ETFs. Something like JEPI for covered call income, JEPQ for tech-focused covered calls, and maybe SCHD for dividend growth. Together, they're yielding maybe 5.5%. That's about $1,900 a year in dividends, $160 a month hitting your account. Every month you get that notification. Every month your brain goes, yes, it's working. This bucket grows more slowly than bucket 1, maybe 6.5% annually. After 15 years, it's at about 90,000. You lost maybe 25,000 in growth compared to if you put it in bucket 1. But here's what you gained. You stayed invested. You didn't panic sell during downturns because you were still getting dividends. You probably added more money because the feedback loop kept you engaged. And that behavior change likely generated more value than the 25,000 you lost in returns. Bucket 3 gets 5,000. You buy whatever stupid thing catches your eye. Maybe you think uranium stocks are gonna pop. Maybe you want exposure to some AI startup. Maybe you just like a company's product. 50-50 chance this goes to 0. 25% chance it doubles. This bucket exists so you don't get bored and start messing with buckets 1 and 2. Now here's the escalation. What nobody tells you is that dividend investing has this built-in gamification structure that compounds the psychological effect. It's not just about getting dividends. It's about optimizing the frequency. There's this whole subculture of people trying to construct portfolios that pay out every single day. Not weekly, not monthly, daily. They're mapping ex-dividend dates across dozens of stocks to create the smoothest possible income stream. Is this necessary? Absolutely not. Does it work psychologically? Oh, you have no idea. I talked to a guy who built a portfolio like this, 58 years old, retired early from corporate sales. He's got about 600,000 generating roughly 30,000 a year in dividends. Works out to about $82 a day. He told me, I know it's stupid, but I can't help myself. Every morning I check my account. Every morning there's money. It's like my portfolio has a job. Then he said something that stuck with me. My friends who have bigger portfolios in index funds, they're always anxious, always checking if the market's up or down. I just count my daily deposit. Market can do whatever it wants. This is the thing about dividend psychology. It creates this mental separation between your capital and your income. In reality, there is no separation. The stock price drops by the dividend amount when it pays out. You're not generating income. You're converting equity into cash. But your brain doesn't process it that way. Your brain sees, I started with X dollars in stocks. Now I have X dollars in stocks plus Y dollars in cash. I am winning. Here's where it gets really interesting. There's this concept in behavioral finance called mental accounting. Richard Thaler won a Nobel Prize for this stuff. The idea is that people treat money differently depending on where it comes from or what it's labeled for. Money you earn from your salary feels different than money you win gambling, even though it's the same money. Dividends tap into this perfectly. They feel like passive income, even though they're really just your assets converting from one form to another. But because they feel like income, people are way more willing to let them compound. If you make $10,000 on a stock sale, you might spend some of it. If you make $10,000 in dividends over a year, you're probably reinvesting it. Same money, different mental bucket, different behavior. But now you're probably asking yourself, if this is all just psychology, what's the actual optimal move? And here's where I'm going to give you the answer that nobody wants to hear. It depends entirely on whether you trust yourself. If you're the kind of person who can set up an automatic investment into an S&P 500 fund and literally never look at it for 30 years, you should do that. You will mathematically end up with more money. But if you're a human being with human emotions who's going to check their portfolio, who's going to feel anxious during downturns, who's going to need some kind of feedback that their strategy is working, then building a psychological reward system into your portfolio isn't stupid. It's adaptive. I've been investing for 15 years. I've watched people make every mistake you can make. And you know what the most common mistake is? It's not picking bad stocks. It's not paying high fees. It's not market timing. It's giving up. It's selling everything after a 20% drawdown because they can't psychologically handle watching their number go down. Dividend investors have lower rates of panic selling during crashes, not because they're smarter, not because their portfolios are less volatile. They're not, but because they're still getting paid. The dividend checks keep coming. And that continuity gives them something to hold on to. 2008, financial crisis. Market down 37%. Guy I know had 200,000 in dividend stocks, lost about 65,000 in value, but his dividends kept coming, about 8,000 that year. Did he feel good? No, but he didn't sell. He kept reinvesting those dividends at crash prices. By 2012, he was back to even. By 2015, he was way ahead. Meanwhile, his neighbor had 200,000 in growth stocks, same drawdown, but panicked and sold in March 2009, moved everything to cash, missed the entire recovery. Same portfolio size, same losses, completely different outcome. Difference was psychological, not mathematical. This is the part where I need to be honest about the downsides, because there are real downsides. First, taxes. In a taxable account, dividends are taxed the year you receive them, even if you reinvest them. Qualified dividends get favorable treatment, 15 or 20% depending on your bracket, but it's still worse than unrealized capital gains that you can defer indefinitely. If you're in a high tax bracket and you're investing in a taxable account, dividends are legitimately costing you money every year. You can mitigate this by holding dividend stocks in tax-advantaged accounts like IRAs, but then you lose the psychological benefit of seeing the cash hit your checking account. Second, lower growth. Dividend-paying companies are usually mature companies. Utilities, consumer staples, REITs. They're not Tesla. They're not going to 10x. A company paying out 50% of its earnings as dividends is a company that's implicitly saying, we don't have better uses for this capital. Sometimes that's fine. Sometimes it means they're out of growth opportunities. The S&P 500 has outperformed dividend-focused strategies over almost every long-term period. That's just reality. Third, concentration risk. If you're building a portfolio that pays daily or weekly, you're probably overweight in certain sectors. Monthly dividend ETFs love covered calls and REITs. That's fine until it's not. Real estate gets hit. Suddenly your diversified dividend portfolio is down 25% while the S&P is flat. But here's my take after doing this for a decade and having real money on the line. The theoretical optimal strategy and the practically optimal strategy are different things. In theory, you should invest every dollar you can into the highest expected return asset and never touch it until retirement. In practice, you're a human with loss aversion and present bias and a brain that craves feedback. Building a portfolio that works with your psychology instead of against it might cost you 1 or 2% a year in returns. But if it keeps you invested and keeps you adding money, you end up ahead. Let me give you 3 things you should actually do if you're serious about this. First, cap your dividend bucket at 25% of your total investable assets. I don't care how good it feels. The math on growth stocks is real. You need that exposure. Most of your wealth should still be in broad market index funds that reinvest everything and compound silently. The dividend portion is there to keep you engaged, not to be your entire strategy. Second, use automation to remove decisions. Set up automatic dividend reinvestment. Set up automatic monthly contributions. The worst thing you can do is start trying to optimize when you buy, or whether you should take the dividends as cash this month. Every decision point is an opportunity to do something stupid. Automate the system and let it run. Third, track your behavior, not just your returns. Keep a simple log. How often are you checking your portfolio? Are you adding money consistently? Did you panic sell during the last market dip? If dividend investing improves those behaviors, it's worth the cost in raw returns. If you're still anxiously checking every day and panicking every time the market drops, then you're getting the psychological cost without the benefit. Switch strategies. Here's what I know for sure. The finance industry wants you to believe investing is complicated because complicated products have higher fees. The FIRE community wants you to believe investing is simple because that supports their anyone can do this narrative. The truth is in between. The math is simple. The psychology is complicated. Dividends are a tool for managing the psychology. They're not magic. They're not optimal. But for a lot of people, They're the difference between staying invested and giving up. Lazy investing built more fortune than crypto memes. But lazy doesn't mean thoughtless. It means building systems that work with your brain instead of requiring you to fight your instincts every day. If daily dividend notifications keep you in the game, use them. If they don't, ignore them. Just don't confuse the tool for the goal. The goal is building wealth. The tool is whatever keeps you showing up.